Hey, what's up, my friend? So, welcome back to another episode of Ask Rayner. And today, I have a question from Zach, right, who asked, Hey, Rayner, how do you manage correlations, right, in your trading, right? So, before I talk about how I do it, right, I want to share with you two things about correlations that, most traders don't quite get. So, number one is this, is that correlations, they are always changing, right? If you look back in time, right, in the 08-09 financial crisis, you will see that the stock markets are declining, going down, right? And if you look at the bond markets, it's actually going up, right? Because, money is taken out of the stock markets into the bond markets as a safe haven. So that is why you have this negatively correlation between the bonds and the stock markets. But if you look at, let's say, recent times, you will notice that both the stock markets and the bond markets are actually, moving up in tandem, right? You can see that their correlation has actually changed over the last few years. So that's the first point that I want to bring across, is that number one, correlations, they do change. So what is correlated in the past does not mean that their correlation will hold in the future. Okay? And number two is this, is that correlations, it can change depending on the time frame you're looking at. Alright, let's say, for example, you trade the FX markets. You notice euro, dollar, and pound dollar, they appear to be correlated on a daily time frame. But if you go down to, let's say, the lower time frame, you might see that, hey, they're actually, negatively correlated. So, second thing that I want to point out is that correlations also depends on the time frame that you're looking at. Okay, so that's two things that I want to bring across. So now to share with you, how do you manage correlations in the market? So let me share with you, a few things that you can use, right? Number one is, I think, is you can divide your risk accordingly. So for example, let's say you are bullish on a euro. You are thinking of buying either Euro Aussie or Euro New Zealand, and you can't decide, man, which markets do I trade, because they are after all correlated. What you can do is, split your risk across, these two currency pair. For example, if you usually risk like 2% on each trade, now what you can do is risk 1% on Euro Aussie and 1% on Euro New Zealand, right? That's the first thing that you can do, split your risk. The second thing that you can do is to, what I call, pick the strongest market to long and to short the weakest market. So if, for example, again, Euro Aussie and Euro New Zealand, you realize that Euro Aussie, right, is a stronger currency to long compared to Euro New Zealand. Maybe because the moving average is steeper, right? Or maybe because Euro Aussie is the first market that broke out, that actually shows that it's stronger. So what you can do is that long the strongest one and ignore the second tier currency pair to trade, right? That's another way you can go about doing it. And the third and final thing to share is it's more of understanding the markets you're trading. There's really no shortcut to knowing which markets are correlated, which are not correlated, how strong their correlation, how weak their correlation, and stuff like that, right? It's really based on understanding the markets, watching the markets, right, and then know which are the different correlations out there, because it's always changing, as I've shared with you earlier, right? So understanding the markets, right, would definitely help, right, you as a trader in dealing with correlations. Okay, so and that's pretty much it, right, for this week's question, right? If you have anything that you want me to answer, just let me know in the comment section below, right, and I'll get back to you, right? And with that said, right, head down to my website, tradingwithrayner.com, right, where you'll learn trading strategies that work, right, so you can get rich slow, right? So with that said, I'll talk to you soon.